If you have ever felt like investing was something other people do, people with more money, more knowledge, or more confidence, this video is going to change that. Investing is not complicated. It has been made to feel complicated by an industry that profits from your confusion. Today, we are stripping it back entirely. What investing actually is, why most professional fund managers consistently lose to a simple low-cost fund you can open in 10 minutes, how compound growth turns modest monthly contributions into life-changing sums, and exactly how to start today regardless of how much you have. By the end of this video, you will understand investing better than most adults in the UK. Let's get into it. Here is the fact that the investment industry does not want you to think too hard about. Over any 15-year period, approximately 85% of actively managed funds run by professional investors paid significant salaries to beat the market, fail to outperform a simple index fund that requires no human management at all. 85%. These are not amateurs. These are Oxford-educated analysts with Bloomberg terminals and decades of experience. And the vast majority of them, over a long enough time frame, lose to a fund that simply buys everything in the market and holds it. The reason matters. It is not that fund managers are bad at their jobs, it is that the fees they charge eat into returns, and the market is extraordinarily difficult to consistently beat. Understanding this single fact is the foundation of intelligent investing. So what actually is investing? At its most basic level, investing means putting your money into something that has the potential to grow in value over time. When you invest in shares, you're buying a small ownership stake in a company. When that company grows and becomes more valuable, so does your stake. When you invest in a fund, you're pooling your money with thousands of other investors to buy stakes in hundreds or thousands of companies simultaneously. The stock market is not a casino. It is a collection of real businesses with real revenues, real employees, and real growth. Over any 10-year period in modern financial history, a globally diversified portfolio has delivered positive returns. The risk is not whether you will make money over the long term. The risk is making poor decisions in the short term because of fear or misunderstanding. Every investment sits somewhere on a spectrum between risk and return. At one end, you have cash. The lowest risk, the lowest return. Your money is safe, but it grows slowly and loses ground to inflation over time. In the middle, you have bonds, loans you make to governments or companies in exchange for regular interest payments. Lower return than shares, but significantly more stable. At the other end, you have equities, shares in companies, the highest long-term return but with short-term volatility. Your portfolio value will go up and down. The key word is long-term. Someone who invested in a global equity index fund in 2007 and did nothing through the 2008 financial crisis would have seen their portfolio recover and grow significantly by 2015. The people who sold in panic locked in their losses permanently. An index fund is a fund designed to track the performance of an entire market index, like the S&P 500 in America or the FTSE All-World globally. Instead of a manager picking which companies to invest in, the fund simply buys every company in the index in proportion to its size. Apple is the largest company in the world, so it gets the largest allocation. A small UK company gets a smaller one. You are not betting on any individual company succeeding, you are betting on the global economy continuing to grow, which over any meaningful time frame in modern history it always has. The result is a fund with no manager fees, stock-picking bias, and historical returns that beat the majority of actively managed alternatives. It is simultaneously the simplest and most evidence-based way to invest. Fees are the silent killer of investment returns, and most investors never properly account for them. An actively managed fund might charge 1.5% per year. A global index fund charges around 0.2%. That 1.3% difference sounds trivial. Over 30 years on a growing portfolio, it is catastrophic. If you invested £500 a month for 30 years at 7% average annual returns, the difference between a 1.5% and a 0.2% annual fee is over £100,000. Not because of anything the fund manager did wrong, simply because of the compounding effect of fees being taken from a growing base year after year. Every pound in fees is a pound that does not compound. And compounding, as you're about to see, is the most powerful force in personal finance. Compound growth is the process by which your investment returns generate their own returns over time. In year 1, £500 a month at 7% generates some growth. In year 2, the growth from year 1 also generates growth on top. By year 30, the majority of your portfolio value is not money you put in. It is growth on top of growth on top of growth. Here are the numbers. £500 a month from age 25 to 65. Total contributions, £240,000. Portfolio value at 65, approximately £1.3 million. Over £1 million was generated purely by compounding. You contributed less than a quarter of the final value. The rest was time doing the work for you. And here is the critical insight. Starting 10 years earlier does not just add 10 years of contributions. It roughly doubles the final portfolio value because of the exponential nature of compound growth. One of the most anxiety-inducing questions people have about investing is when to start. What if the market crashes right after I invest? The answer is pound cost averaging, investing a fixed amount at regular intervals regardless of what the market is doing. When the market is up, your fixed amount buys fewer shares. When the market is down, the same amount buys more. Over time, this averages out your purchase price and removes the need to time the market perfectly. The evidence is clear. Time in the market beats timing the market for the vast majority of investors. A person who invested every month for 20 years, including through multiple market crashes, consistently outperforms a person who tried to invest at the perfect moment and missed even the 10 best trading days of the decade. Here is the practical path from zero to invested. Step 1. Open a stocks and shares ISA. This gives your investments a tax-free wrapper so all growth and income is yours. We covered ISAs in episode 1. Step 2. Choose a provider. Vanguard, Fidelity and Trading 212 are all solid options with low fees and straightforward interfaces. Step 3. Choose a fund. For most beginners, a single global index fund is all you need. Vanguard's FTSE All-World ETF, iShares MSCI World, or Fidelity's Index World Fund are all excellent starting points. Step 4. Set up a monthly direct debit. Automate your contribution so it happens without thought or willpower. Step 5. Do nothing. Check it annually. Let compounding do the rest. The entire process from opening an account to your first automated contribution takes under an hour. How much should you actually invest each month? The honest answer is whatever you can sustain consistently is better than a large amount that you stop after 6 months. The power is in consistency, not size. A starting point that works for most people is to invest whatever remains after your essential expenses and an emergency fund contribution, even if that is £50 a month to start. What matters more than the amount is the habit, because as your income grows, your contributions can grow with it. The concept of paying yourself first is useful here. Set up your investment direct debit for the day after payday, before lifestyle spending has a chance to absorb it. Most people are surprised how quickly they adapt to a slightly smaller spending budget, when the alternative is a growing investment portfolio they can actually see working. Let us come back to the active versus passive debate with actual numbers. A £15,000 investment in the average actively managed global fund over 20 years, assuming average returns and a 1.5% fee, grows to approximately £44,000. The same £15,000 in a passive global index fund at the same gross return but a 0.2% fee grows to approximately £58,000. Same money, same market, same time frame. The difference is purely fees and the compounding effect of those fees being absent. £14,000 extra, simply from choosing the lower cost option. When you understand this, the entire premise of paying a premium for active management becomes very difficult to justify for the average long-term investor. Diversification is the one genuine free lunch in investing. By spreading your money across hundreds or thousands of companies in multiple countries and sectors, you reduce the impact of any single company failing. If you invested everything in one company and that company collapsed, you would lose everything. If you invested in a global index fund holding 3,000 companies and one collapsed, you would barely notice. A global index fund gives you automatic diversification across the US, Europe, Asia, emerging markets, technology, healthcare, consumer goods, financials, and more. You do not need to research individual companies. You do not need to decide which sectors will outperform. You simply own a slice of the entire global economy and benefit as it grows. Every cell on this chart represents 1 year of global market returns. Some years are deeply red: 2008, 2002, 2022. Some are strongly green: 2009, 2013, 2019, 2021. Looked at individually, the pattern appears almost random. You cannot predict which colour the next sell will be, and neither can anyone else. But step back and look at the full picture. Out of 25 years shown here, 18 were positive. The negative years were followed, without exception, by recovery. The market does not go up in a straight line. It never has. But over any meaningful time frame, it has always gone up. The lesson is not that investing is without risk. The lesson is that time is the tool that converts short-term unpredictability into long-term certainty. The people who stayed invested through every red cell on this chart came out significantly ahead of those who did not. 3 mistakes that cost investors significant money. First, trying to time the market. Waiting for the perfect entry point is how people miss years of compounding. The best time to start is now. The second best time is tomorrow, not after the next correction. Second, panic selling during downturns. Market crashes are temporary. Every single market crash in modern financial history has been followed by a recovery to new highs. Selling when the market drops locks in your losses permanently. The investors who held through 2008 recovered fully within 5 years. The ones who sold did not. Third, over-diversifying into too many funds. Buying 10 different index funds does not give you more diversification. It gives you more complexity and often overlapping holdings. One well-chosen global index fund is genuinely all most people need. Let's bring this together with a final comparison that puts everything in context. 3 people, all invest from age 25, all put in £300 a month. Person 1 keeps the money in cash at 3%. By 65, they have £220,000. Person 2 invests in a high-fee active fund at 6% net. By 65, they have £580,000. Person 3 invests in a low-cost global index fund at 7% net. By 65, they have £840,000. Same monthly contribution, same start date. The difference between cash and investing is £620,000. The difference between the high-fee fund and the low-cost index fund is a further £260,000. These are not theoretical numbers. They are the mathematical consequence of decisions most people make without realising the long-term impact. Investing is not reserved for the wealthy, the financially educated, or the naturally confident. It is a system available to everyone, backed by over 100 years of evidence, that turns consistent, modest contributions into substantial long-term wealth. The only requirements are starting, being consistent, keeping fees low, and leaving it alone long enough for compounding to do its job. Every month you wait is a month of compound growth you cannot reclaim. The market will always feel uncertain. There will always be a reason to wait. The people who build wealth do not wait for certainty. They invest anyway, because time in the market is the entire point. Next week we're covering credit scores, what they actually are, how they're calculated, the myths that are quietly costing people money, and exactly how to improve yours. Subscribe so you do not miss it. New videos every week.